AI-driven equities are pushing toward record levels, even as energy shocks, sticky inflation, and geopolitics keep the macro backdrop fragile. Welcome to vTalkInsight, Allocator's Lens Daily for May 8, 2026. We will connect the dots across equities, rates, credit, currencies, and commodities so that cross-asset risks and opportunities stay in clear view. In equities, the dominant story is still a powerful, AI-led advance, taking global benchmarks to or close to record highs. Strong nominal growth, with estimates of GDP running near 6%, is feeding robust earnings and pricing power, and that is giving this rally real fundamental backing despite all the macro noise. AI infrastructure is the engine behind that strength. Chip makers are surprising on the upside, with names like AMD jumping sharply after earnings, and ARM highlighting multi-billion-dollar order books for new data center chips. Hyperscalers are on track to spend the equivalent of about 1% of GDP on digital infrastructure, while specialist data center players are locking in long-term, investment-grade leases that support sizable bond deals. The AI impulse is global. Japanese technology stocks, including major platform and chip names, have surged after holidays, helped by the broader semiconductor upswing. In Europe, travel, leisure, and tech are leading recent gains, and stock stories tied to AI and the energy transition, such as electrical equipment makers and wind turbine manufacturers, are posting solid earnings and order backlogs. Beneath that surface, though, the real economy looks less exuberant. Real consumer spending growth has slowed from roughly 2.5% to 3.5% into the 1.5% to 2% range, with further deceleration expected. Companies exposed to big-ticket and discretionary demand, from appliance makers cutting guidance to beverage and smartphone suppliers warning on volumes, are signaling softer sentiment and pressure on durables. Valuation and market structure add another layer of risk. Forward price to earnings on U.S. equities is approaching the mid-20s, with earnings yields now only comparable to two-year Treasury yield around 4%, and only about a fifth of S&P constituents beating the index. Commentators liken this to late 1999, arguing that AI momentum could still push prices perhaps 40% higher, but also warning that the eventual correction could be violent. At the same time, the AI theme is starting to broaden beyond the megacaps, reaching hardware, optical and telecom infrastructure, and international tech, while structural forces like defense spending, industrial reshoring, semiconductors, and utilities all stand to benefit from geopolitical fragmentation and economic nationalism. The near-term watch list is crowded. The upcoming Trump-Xi meeting, U.S. Iran negotiations over the Strait of Hormuz, and episodic oil volatility all have scope to inject short-term swings into what remains a broadly constructive 12-month equity backdrop. Turning to rates, the picture is one of higher for longer rather than imminent easing. The Federal Reserve is widely expected to keep policy on hold for the foreseeable future, despite strong growth, a budget deficit of around 6%, and solid labor data. And some see a non-trivial risk that the next move could actually be a hike instead of a cut. Elsewhere, central banks are already tightening in response to sticky inflation. Norway has surprised with another hike, taking its key rate above 4%, and policymakers in economies like Australia are reacting to wage pressure, even as the Bank of England worries that recent upside surprises in UK data may be misleading. Bond markets are pricing higher inflation risk, particularly in Europe, where energy shocks and Middle East tensions complicate policy for the ECB. At the same time, global investors are starting to scrutinize developed market sovereigns with the same intensity once reserved for emerging markets. The U.S. Treasury has shifted the bulk of new issuance into short maturities, with well over 4/5 in paper inside 1 year, raising rollover and interest expense risk and sparking debate about how sustainable current fiscal paths really are. Despite those worries, demand for both government and corporate bonds remains solid, but return expectations are increasingly about carry rather than capital gains. With 10-year U.S. yields expected to hover around the mid-4s and policy rates unlikely to fall quickly, segments like agency mortgage-backed securities and AAA-rated CLO exposure, yielding close to 5%, are being used more as steady income streams than as classic recession hedges. In credit, public markets still look remarkably calm given the headlines. High yields on corporate bonds remain attractive for many institutions, and with growth strong and earnings resilient, the risk of a classic default wave is seen as contained, even as pockets of stress emerge in areas like private credit and legacy software. Beneath that surface, concerns are mounting over the private credit boom. Rapid growth, reminiscent of pre-crisis mortgage and dot-com periods, has been accompanied by limited transparency, real defaults, and sharp markdowns, with some loans written down from par to the low 80s and funds reporting net asset value cuts of several percent overnight. Gating earlier this year has set the stage for a potential wave of redemption requests in June as investors seek liquidity. Sector dispersion is also increasing. In software and tech, credit risk is rising where AI applications threaten legacy business models, widening spreads and creating a clearer divide between perceived winners and losers. At the same time, demand for AI-linked bond issuance is strong, helped by a post-pandemic shrinkage in overall corporate supply, even though the long-term return on this capital-heavy investment cycle remains uncertain. On the sovereign side, a U.S. deficit north of $2 trillion is limiting future fiscal flexibility, and some analysts even float extreme scenarios where coupon payments might be restructured to reduce the interest burden, underscoring why term premia could rise from here. For allocators, the key is that while public credit spreads still signal stability today, stresses in private vehicles and questions over fiscal sustainability could become more important drivers over the next cycle. Foreign exchange markets are increasingly reflecting risk appetite rather than straightforward policy divergence. The dollar has retraced back to pre-conflict levels on broad indices, giving up the gains it made when Middle East tensions first flared, even though U.S. growth, labor markets, and terms of trade remain supportive on paper. Carry remains a central theme. Currencies in countries like Brazil, Hungary, and Turkey still offer appealing yield pickup, especially where domestic fundamentals are seen as robust, while the Korean won is benefiting from strong exports and renewed foreign equity inflows. In contrast, the Mexican peso looks more vulnerable as domestic rate cuts narrow its yield advantage and negotiations around the North American trade agreement add another potential shock source. Policy intervention is another feature of this landscape. Bank Indonesia has been leaning against persistent rupiah weakness, and in Japan, authorities have stepped in to slow yen depreciation, although history suggests that without a sustained shift in underlying rate differentials, such moves rarely change long-term trends. Political noise and commodity swings are likely to remain the main drivers for euro, sterling, and many emerging currencies as the next round of geopolitical headlines hits. Commodities, and oil in particular, remain the macro hinge for the next leg of this cycle. Brent has fallen back from the $107 to $108 area to below 100, and even in the high 90s, while New York crude has dropped a couple of percent, reflecting optimism that negotiations between the U.S. and Iran could ultimately reopen key shipping lanes. Yet the physical backdrop is still tight. The Strait of Hormuz remains heavily constrained by naval blockades and mines, with only narrow, escorted corridors open and multiple vessels stranded. Estimates suggest that as much as 500 million barrels of oil could stay off the market during just a 30-day negotiation period, while shipping companies face roughly $1.5 billion of extra quarterly costs that they are passing through via sharply higher freight rates. This feeds directly into inflation and policy risk. Freight indexes in parts of Asia are already up around 40%, and concerns about jet fuel shortages, alongside rising input costs for restaurants and households, highlight how commodity shocks filter quickly into consumer prices. It is against this backdrop that some see room for gold to move significantly higher into 2025, with strong buying interest projected on any meaningful pullback. At the same time, the energy transition is accelerating and intersecting with the AI build-out. Wind and renewable developers report record order books, with auctions in Europe clearing at 60 to 70% of current grid prices and U.S. projects reportedly being built at less than 40% of local power costs. While higher interest rates and permitting delays have challenged the sector, the combination of energy security concerns and attractive economics is driving sustained capital into real assets, reinforcing commodities and infrastructure as a central plank of the multi-asset discussion. Stepping back across assets, The picture is of equities priced for strong AI-driven growth, sitting on top of a rates complex that looks firmly higher for longer, credit markets that appear calm on the surface but conceal growing private stress, currencies guided more by risk appetite and carry than by policy spreads, and commodities that remain the key swing factor for inflation, shipping costs, and ultimately central bank reactions. For allocators, the near-term focus is likely to stay on how U.S. Iran negotiations and the Trump-Xi summit reshape energy risk, how labor data and inflation prints feed into term premia, and whether private credit redemption pressures stay ring-fenced from public markets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.